Welcome to the Explainer. All right, let's jump right in. Today we're tackling something huge in the investing world, especially in Taiwan, the massive craze for high-dividend ETFs.
So let's get right to the heart of it with a pretty provocative question. Is the payout you're getting from your high-dividend ETF, well, is it a lie? I mean, funds like 00878 and 00919 are absolutely exploding in popularity, and everybody wants to know if those juicy-looking dividends are the real deal.
And you can totally see the appeal, right? Especially if you're a long-term investor, part of that deposit stock tribe, that swing gutsu, and you're just looking for some steady, reliable cash flow. I mean, a yield of over 10%? That sounds like the dream. But is it too good to be true?
All right, so let's talk about this high dividend dream. And to really understand it, we've got to ask a crucial question. Where is this money? Where do these payouts actually come from? Because the answer, you'll see, is a little more complicated than you might think.
Okay, here's a term you absolutely need to know: the Income Equalization Fund. Now, a really critical thing to get here is that this is not profit. Let me say that again. It's not profit. It's actually a chunk of the money that new investors put into the fund, and its job is to keep the dividend rate looking stable for everybody as the fund gets bigger and bigger.
So let's look at the anatomy of a typical payout. This is where it gets really interesting. See that chart? Only about 57% of your payout is coming from what you'd expect, actual company profits. But look at this. A whopping 29% is being pulled from that income equalization fund we just talked about. Think about that for a second. That means almost a third of your so-called dividend isn't a dividend at all. It's just other investors' cash being recycled back to you.
So, let's break it down one more time just to be super clear. Your payout has four main sources. First, you've got your dividend or profit income. This is the real deal, the classic dividend from company earnings. Then you have capital gains, which is the profit the ETF makes from selling stocks. Third, a tiny slice from something called capital reserves. But then there's that fourth one, the big one, the Income Equalization Fund. And that, remember, is just new money flowing into the ETF from new investors.
You know, this whole situation has led a lot of investors to use this really powerful metaphor. They say it feels like you're just taking money from your left hand and moving it to your right hand. And that really hits home, doesn't it? You're basically getting a piece of your own money, your own principal, back. It's just dressed up to look like a dividend.
Okay, let me give you an analogy that makes this super easy to understand. Think of the ETF as a big water reservoir. The rain filling it up? That's the dividends from the companies it owns. Now, the ETF promises to let out a steady stream of water every quarter. That's your payout. But here's the problem. What happens if a ton of new people show up wanting water, but the amount of rain, the actual dividends, doesn't change? Well, the water level would drop, right? So, to keep that stream flowing steadily for everyone, the fund manager takes some of the entry fee from the new people and uses it to top up the reservoir. The payout looks great and stable, but you know it's not all coming from the rain.
Okay, so now we get how these payouts are put together. But the real question is, what does this actually mean for your money, for your wealth? This brings us to the most important concept of all, the difference between high yield and total return.
There's a quote from an investment expert in our source material that just says it all. Yield does not equal return, and high yield absolutely does not equal high return. Seriously, if you take one thing away from this whole explainer, let it be this. Chasing that flashy, high percentage number can be a major trap if you're not looking at the whole picture.
All right, let's make this super concrete. Check out this table. We're comparing two of Taiwan's most famous ETFs. On one side, you've got 0056, a classic high-dividend ETF. Its entire goal is to give you stable cash flow. On the other side is 0050, a market cap ETF. Its goal is different. It wants to capture the growth of the entire market. And its key metric isn't yield, it's total return. That's the stock's price gain plus the dividends. Now, look at the results over 10 years. The high-dividend fund? 187%. Hey, not bad at all. But the market cap fund, a jaw-dropping 284%. That is a massive difference, nearly 100 percentage points.
So does that huge difference in returns mean one of these is good and the other is bad? Not at all. What it really means is that you have to stop and ask yourself, what is my strategy? What am I trying to achieve? It's all about picking the right tool for your specific job. Think about it like this. Are you, say, a retiree? Do Do you need that stable, predictable cash flow to pay your monthly bills? In that case, a high-dividend ETF could be a really good fit. The stability is what you're paying for. But what if you're a wealth builder? You're still working, you're trying to grow that nest egg as big as you possibly can for the future. Well, the numbers we just saw strongly suggest that a market cap ETF, the one focused on total return, is probably a much more powerful engine for long-term growth.
So let's really put a fine point on this. Let's translate that percentage difference into actual, cold, hard cash.
Let's say you had invested 1 million new Taiwan dollars 10 years ago in each of these. By choosing the strategy focused on total return instead of just high yield, you would have ended up with almost 960,000 TWD more in your account. That's nearly $1 million. That is the very real-world cost of just chasing yield without understanding the full picture.
And that really brings us to the final, most important question you need to ask yourself. It sums up everything we've talked about today. Are you investing for income or are you investing for wealth? Knowing the answer to that question is really the key to making the best choice for your own financial future. Thanks so much for joining us on The Explainer.